Hello, everyone. It's Professor Reiko here again. Today we are covering, continuing on with equity securities in our investment chapter. And we're going to focus now, we're going to do a comparison of the fair value and the equity method for accounting for equity securities. So let's just jump right into it. We acquire a company, 50,000 shares, which is 20%. So 20% is kind of the cutoff between the fair value and the equity method. We talked about some of that over the past couple of videos. And so what we're going to do on the equity method side, we'll assume they have significant influence. Therefore, they use the equity method. On the fair value method side, we'll assume they don't. All right, so they buy 50,000 shares at $10 per share. And then at the end of the first year, there's net income reported by the investee. Their shares had gone up in value. The next year, there's a dividend. There's actually a net loss in that year, and then their shares go down to $9. All right, so what we're going to do here is just a side by side, so it makes it easy to compare the different methods. All right, so we'll start on January 1, 07, and this is when we purchase them. All right, so we're buying 50,000 shares at $10 a piece. All right, so we get cash. We are putting the equity investment on the books. And we're paying cash. All right, so that's going to be 500,000 because it's the 50,000 shares times $10 per share. All right, over here, it's the exact same journal entry. All right, so we record it at 500,000. Remember, equity investment also gets recorded at cost, so therefore our first journal entry is going to look the same. All right, so let's jump ahead to the end of the year. Okay, it says XYZ, the company that we invested in, reported net income of $450, and their shares had gone up from $10 to $12 a piece. So let's handle that portion first over here. So we're at 12/31/07. All right, so remember, the cost is 500,000. The fair market value is 600,000. All right, so we can see we have an unrealized gain of 100,000. Now look, this is the first year, so there's no beginning balance in the unrealized account and the fair value adjustment accounts. We just go on and record that number, 100,000. All right, so we have a fair value adjustment for 100,000. And then we have the unrealized holding gain or loss. And I'm just going to abbreviate that just for this little tight on space here. All right, so that records that. Now remember, there's no fair value adjustment on this side. I mean, we don't adjust it up or down for fair market value changes. How we do adjust it is for our share of the changes in the investees' net assets, meaning we're looking at the changes in retained earnings and how that affects equity. All right, so if an increase in retained earnings, we will increase our investment. If something decreases retained earnings, we'll decrease our investment. Remember, the equity method, every journal entry has a debit or credit to the equity investment, which should help make things a little easier. All right, so this is also 12/31/07. Look, now on this side, there's no net income adjustment. We don't adjust for our share of the income. Over here, we do. So remember, the equity investment, they had income. Income increases retained earnings. Therefore, we are going to increase our investment. Now, remember, they reported income of $450,000, and we are a 20% owner. So therefore, we are going to increase our investment by $90,000. All right, so we do that by debiting the investment 90, and we just call this investment income 90,000. All right, so it's important to note we're not getting anything here. They're not sending us part of their income. It's just saying we have this economic relationship with them. We have significant influence, and therefore, as they prosper and their retained earnings go up, we are going to increase our investment in them, and then vice versa if it goes down. All right, so let's jump ahead to the next year. We're on February 1st of 08, and there's a dividend. All right, so look, it says they announced and paid a cash dividend of $150,000. Now remember, we're a 20% owner, so that means we get 30% of that. So we are getting a cash dividend of $30,000, and we call that dividend revenue $30,000. All right, on the equity method side, we're still getting cash for $30,000. All right, but now remember, dividends reduce retained earnings, therefore it reduces their equity, so we are going to reduce our investment by $30,000. All right, now let's jump ahead to the end of the year. All right, this time there's a loss, and then the shares had gone down to $9. All right, so I'm gonna scroll down a little bit here. All right, so let me come down here to the bottom. Let's do the so we're at 12/31 of 08. And let's do the market value adjustment first. All right, so if we come down here, remember the cost is still 500,000. The fair market value is now 450,000. All right, so that means the unrealized gain or loss is now 50,000, and that's a loss. So if you think about our T account for the unrealized account, all right, remember we started with 100,000, and I'm gonna leave off all the extra zeros, but we're saying now we want it to be a loss of 50. All right, so therefore remember that's the 50 right there. So our adjusting journal entry needs to be a debit to the unrealized gain loss account for 150. All right, so let's get that in there. So we have the unrealized gain or loss dash net income for 150,000. And then our credit, remember, is just the fair value adjustment account for 150,000. All right, remember, there's no fair market value adjustment over here. All right, there is, however, the adjustment for income. In this case, it's a loss. So I'll put no net income adjustment here, and then we'll come over here. All right, so now we have a loss of 80,000. So our share of that is 16. So we had investment income up here. Now we just call this investment loss, and that's going to be 16,000. All right, and then remember we are decreasing. If income increases their retained earnings, and the loss obviously decreases it. Therefore, we're going to decrease our investment. And once again, I took the $80,000 loss times the 20% to get that 16,000. All right, so if you notice some of the differences, the cost over here is still 500,000. That's the carrying value of the asset. Over here, the equity investment is influenced by every transaction. All right, so we started at 500, and then we added 90, and then we subtracted 30, and then 16. So our updated value is 544,000. So when we go to sell the asset, which we don't do in this example, you are going to be comparing 544 to the sales price, as over on the other side you're going to be carrying 500 to the sales price. So it's a little bit different. It could make whether there's a gain or loss show up different depending on how you classify the investment. All right, so this is just a good comparison, and I believe most of your textbooks should have an example where they compare these side by side as well. So use all these examples to your advantage, especially when you're reviewing for the test. The more examples you look at, the better off you're going to do on the test. All right, so hopefully this one is helpful as well. Please hit like and subscribe to the channel and share with all your classmates as well. And we'll tune in next time as we wrap up the videos on investments. Thanks.